we're not really too concerned about how much you owe the entire account, even though that takes a huge role, but we also factor in the minimum payment. So let's just say you have a credit card that you owe 2,000 bucks on and you only pay 25 bucks a month on. And you have another one that you only owe 1,000 bucks on. And for some reason, you have to pay 100 bucks a month. The $1,000 credit card is actually doing more damage than the $2,000 credit card, even though it sounds weird because the minimum monthly required payment is bigger. And that's how we measure your debts. Hello and welcome to Mortgage Ace Hacks. I am José Plascencia, and this is a podcast where we talk about home loans, financing, real estate, and in general, building wealth of real estate. And today, we're going to talk about a very common question that I get asked all the time. Is it necessary to pay off debt prior to getting a home loan? Stay tuned and watch the full video because the answer will most likely surprise you. Why does it benefit? Why is it a benefit to pay off your credit card debt prior to your home loan application? And is it always a good thing, or can it also mess up or kind of hinder you from getting your loan approved? Kind of depleting your funds and all that. Should you be tight on funds? Stay tuned because both have their pros and cons. And if you're still unclear about what we talked about, please go and visit episode 2, where I lay down the whole footprint of pretty much the main importance of getting approved for a home loan. Episode 2. Okay, so we're going to talk about which debts should you concentrate on paying first. So let me break one thing down. Obviously, when it comes to getting a home loan, most lenders take a look at your DTI, your debt to income ratio. Okay, so we need to lower your debt to income ratio down, or when we need to pay off some debt, it's usually because the monthly payment is a large amount. We're not really too concerned about how much you owe the entire account, even though that takes a huge role, but we also factor in the minimum payment. So let's just say you have a credit card that you owe 2,000 bucks on and you only pay 25 bucks a month on. And you have another one that you only owe 1,000 bucks on. And for some reason, you have to pay 100 bucks a month. The $1,000 credit card is actually doing more damage than the $2,000 credit card, even though it sounds weird because the minimum monthly required payment is bigger. And that's how we measure your debts. Granted, if we need to pay it off, you're going to have to pay it off what you need to pay off. But if the bigger monthly payment is bigger, that's what's going to mess you up more. So we're going to tell you, concentrate on the accounts that have the biggest, or they're asking for the bigger monthly payment. Another topic that we're going to talk about is how to keep your credit in the most optimal shape. And that's different myths, different things what people tell you, but I always tell clients, go off the 30% rule. Some people say the 50% rule. Algorithms show more 30% rule, which means if you have a credit card, and keep in mind, credit cards were originally designed for emergencies. If you have a credit card and they let you borrow, or your credit limit is 1,000 bucks, $1,000, do not use more than $300. It's important to maintain an outstanding balance, but do not make sure it doesn't go more than 30% because that shows you have discipline with your finances. They're letting you borrow $1,000, but you're choosing only to use $300. That shows you have discipline versus you max it out 500, 700, 1,000. You just maxed it out. That shows you need that credit card to survive. You need that credit card to get by, or you just don't have no discipline and you're just going reckless, swiping away on stuff you don't need. That's what's going to give you a low credit score versus a high credit score. Another thing we're going to talk about is why closing old accounts or closing accounts could be a mistake. And honestly, guys, yes, I always tell clients, pay off your credit cards, pay down your credit cards, but do not close them because part of the credit algorithm, and it's an algorithm that factors a ton of different things that generate that credit score. And part of that algorithm is oldest credit lines. If you had a credit card for 5 years, 10 years, and you never been late on it and you're paying it and all this other stuff, cool. That's going to be good because shows you're able to establish a relationship, a partnership with that creditor, and you're able to abide by the rules. In return, they're going to give you a higher credit score. If you open up new credit cards here and there and you keep canceling them, sometimes your credit score might not jump as high as you want it to be because all your credit cards are showing new accounts. It's not going to grade it. So do not cancel your credit cards in good stand. So I'm going to give an example of someone that decided to pay off all their credit cards and it backfired on them. So one had several cases. One is they thought they had to pay off their credit cards and they paid them off. cool. They paid them off. They're debt free, but now they got no money for the down payment, and they don't qualify for any down payment assistance programs, and they have no one to give them a gift. Technically, they don't have funds for a transaction. Remember, the home loan approval is credit, income, and assets. They don't have money for the down payment. That's an easy example. Now, one that we have been seeing recently that has been kind of catching us by surprise is we have clients that maybe have a credit card or have a credit score. They paid off their credit cards and they kept their accounts zero for a few months. We're starting to see that their score is coming back non-scored. So I might have pre-approved somebody with a 700 score back in January. They paid down their credit cards back in April. They kept them zero. They have no usage on their credit cards. And then come August, for example, I repool credit and now that 700 is now coming back as a no score. That can and will affect your loan approval. We can still get the loan done, but it's going to be more costly. And if this episode has helped you gain knowledge or know what to do and what not to do, please subscribe to my channel. Subscribe, and leave comments for feedback and other stuff you would like me to talk about. We go off of your feedback. Keep the channel going.